for CFDs or if you're trading actual Forex or if you're trading stocks. But price action is short-term trading. So to really understand price action means you have to study what happened in the past, then observe what is happening in the present, and then predict where the markets will go next. That sounds really complicated, doesn't it? Basically, price action is reading a chart, looking at price on a chart, and understanding what it's trying to tell you. It's not about using complex strategies. It's not about using involved applications such as, technical analysis indicators like MACD and RSI as stochastic. It's about looking at the price on a chart, looking how that asset's traded and what those price movements have told you. Now, however, there's still a lot of misunderstandings and half-truths circulating that confuse traders and set them up for failure. So what exactly is price action? It's a favorite among short-term to medium-term traders. Price action trading brings together an interesting mix of information and different views. These include historic price patterns, technical indicators, and the investor's ability to read the market. Many investors see the market as an information exchange where all the views and strategies meet and try to arrive at a fair price in the end. This explains why price action trading strategies do not involve fundamental analysis of an individual market or commodity. In other words, you're not looking at a stock and breaking down its ROI and what the sales were and what it's doing, because that's for long-term investing. Okay, we're looking for short-term decisions based on where the price is at the moment to where it might be going in the next few moments or the next hour. We're not looking at X, Y, and Z and saying, well, this share is really worth $147 because if we look at the sales, the growth of the company, because we only care that's at 145 now, and we think it's going to have the momentum to take us to 150. Okay, or maybe the whole stock market's falling at the moment, so we think it's going to drop down because of overall pressure, or maybe some bad news about that particular industry or sector. We don't really go into the fundamental analysis to break down all of the stuff. We're trying to look at the price on the chart and see what it's telling us. So as many of the decisions associated with price action trading are subjective, what one investor may see as a breakout, another may see as a potential price reversal. Compare and contrast this with pure technical analysis, where you are effectively ignoring the experience of the investors in favor of cold hard trends. Human nature dictates that futures and commodity prices can be extremely volatile. Overbought situations are often created because of fear and greed, while panic selling may take over the event of disappointing news. These are all types of scenarios where price action investment strategies have proved to have extreme potential. So ultimately, it comes down to how you read price on your charts. You'll hear talk about swing patterns, support and resistance, wave analysis, trend lines, moving averages, to name a few different chart patterns. And then you'll talk about candlesticks and bars that are very popular. So let me pop up a live chart here on our screen. Okay. So this is the current live chart for the Euro USD, the 30-minute chart we're looking at. And this is my teaching chart. I haven't picked this asset because I'm making any recommendation. I always teach from this chart. Okay. Now, the lines going across the chart, whether they're dotted, dashed, purple, red, gold, these are support and resistance levels. Support and resistance levels are one of the most important things a price action trader uses. Support and resistance isn't very complicated. And these lines you see on my chart, the reason they're color coded is my personal coding. It has nothing to do with you. You have to develop your own legend in how you tell yourself. But the importance of support and resistance and why I've got them dot and dash and go It tells me how important that level was, because what support and resistance come is from looking at your charts in the past and looking at where important levels in that price movement in the past have occurred. Where did an uptrend get stopped? Where did a movement get stuck? Where did the assets, where did the price congel before it moved up? There's many things we want to look at. Okay. And your support and resistance lines, once they're on your chart, stay forever and move forward as your charts move forward. So as you see, these levels here, okay, are inconsequential now that the price has moved up to here. Okay. These levels now become more critically important. But I didn't draw them on today. Some of these levels are almost a year old, because what we're looking for is, I'm going to stop for one quick second. Okay. The question box is not a conversation between you and me. It's for questions. The questions should be focused on what we're talking about now, not what you're looking out in left field, because I will get to all of these things if you let me get there. But jumping out with questions that I haven't come to yet is like teaching a group of kids in school. You know, when the teacher's up there trying to teach you how to spell bat, give her the time to explain what B-A-T is. So sit back and enjoy the ride. If you don't understand something I'm telling you, please ask me. But please don't go off in left field. Okay, I'm sorry. I'm going off in left field. But it's very important to sit that I will promise that I'll go over everything. Okay, now, these levels on, okay, like I said, when the asset passed in this price range 6 months ago, 8 months ago, 12 months ago. Now the euro, when we were down like the 105 and 106, had never even traded in those ranges, so they were new. But the one right now, we're getting into ranges that we've had a lot with the euro in the last year, and that's the 110, 112 range. And these lines were drawn on back, whatever that asset has moved in this range, to find what price level is important. And the computer system or the chart system just extends them forward forever, because they'll be good in 3 months from now, they'll be good in 6 months from now, they'll be good in a year from now. Whenever the asset comes into this range, these are the prices that are important to us on our charts. And we can see, as the euro moved in this level before, what happened at these levels. Look, price is moving up, and what happened at this support or resistance level. Now, support and resistance levels are interchangeable words. Imagine support and resistance like the steps on a ladder. When you're climbing up that ladder, those steps carry you up. When you're climbing down the ladder, they're the same steps in the same place, but you're stepping down on those. So this line right here, as price is moving up, is a resistance line. But once price breaks through it and is coming back towards it again, it becomes a support line. Okay. So think of these as just as the floors on an elevator or the steps on a ladder. You don't want to miss that step when you're going up the ladder, and you sure don't want to miss that step when you're coming down the ladder. And knowing where those steps are critically important. Now we have whole classes on just what I call eyeballing support and resistance. Now, the fact is, it's time consuming to get these on your charts. But once they're on your charts and you're using them all the time, it takes you no time. Okay. Now, you're constantly adding these lines on based on new price movements, but these lines, I said, they were extended forward from months and months and months ago when the asset was trading in this range. Now, I can notice on this chart that maybe we have a new level of importance right here. Because look at how That level has been crucial in every movement of this price. So we saw a price move up and got stuck here and bounced down. There's no analysis. There's nothing. This is what makes you a better trader than the guy sitting next to you or across the world. It is how you find these areas and what you do with them. Okay? Because this is there's no law, there's no rule. Some people take swing highs and swing lows. Some people take all different kinds of things. I use my eyeballs. So I can see that right here, the 109,814, okay, has been a crucial level and has become a currently crucial level. So that becomes an important item. Now, for me, my short-term levels I put on in solid lines. Okay, this is a new level, so we put on as bold and green, and it's going to extend forward. As time passes, I will probably change this to a purple dash line, which tells me it's a significant level, but it wasn't from this short-term period. These are, like I said, these are my color codes. Okay, the important part is knowing where those steps are in the ladder up and down. Now, even though I use steps on the ladder because it's important that when you're climbing down, you know, and you can't see the steps below you, you can feel them. With these steps on the chart, you have to realize that they're not finite numbers. Okay. You can't say that we just drew this line on at 108.81. I can't even see my 109,819. Okay. You could say 109,819 is a significant support level or resistance level or the step on the ladder. But the fact is, we didn't really exactly put where this number is to 4 digits. So think of these steps as a zone, a tiny zone, but a zone. So I wouldn't say 109,819 is my critical number. I know that somewhere around 108.9 is a critical level. So always give yourself some pips above and some pips below. But your support levels and your resistance levels are critical elements of understanding what this asset is doing at the moment. Okay. And making your decision based on price action, because together, price and these levels are speaking to you. Now, we don't use this to make trading decisions, but we do use it for making having trading information. Okay. We do use it for setting our stop losses. We might even use it to set our entry points. So you can see here on this chart where my support and resistance levels have been combined with Fibonacci's as well as trend lines. Okay. And we can see the explanation where strong support and it tested it held here. Support out here turned to resistance and support. Okay. And if we combine them, say, with our Fibonacci levels and they're overlapping, it even gives us twice as much information. But you decide how you're going to look at your charts and what you're going to use to interpret them. Another thing you might want to look for on your charts are chart patterns. Okay. Now, here are all the standardized chart patterns. Now, I don't look at most of these because most of them are irrelevant in our trading methods, okay, because they take too long to develop and they're too complicated to see for us. And the rules of them trading become very complex. So it's like trying to trade from Chinese candlestick patterns and memorizing the 72 important patterns and then trying to see them all the time. You could spend your life looking for these patterns and never make a trade. And each one of those patterns has an interpretation that's trying to tell you what to do. Just like these patterns. And you can read all kinds of things about when you see a head and shoulders that you should do this, and when you see an upward bullish flag, do that. You can get lost in it. What's important is seeing a pattern and knowing that it's there and then waiting for the breakout of the pattern. So we have things like head and shoulders, inverse head and shoulders, double bottoms, double tops, triple bottoms, triple tops. But in our detailed charts and our fast-paced moving market, okay, a head and shoulders takes way too long to develop. Where a double top, double bottom, or triple top, triple happens so often that yes, you can see that the price is now trading between certain price levels, but you don't need to have a definition to have them. Looking at your chart, you'll see the price making tops and bottoms overly. So I'm a firm believer in chart patterns, though, but I combine this, 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 all into what I call triangles. I learned in school that anything that has two converging lines and a base is a triangle. Okay. Now, there's all kinds of definitions for an ascending wave, a wedge, and a descending wedge, and a bullish pennant, and a bearish pennant, and an expanding wedge, an ascending triangle, descending. Forget it all. In price action, we're only looking for the development of a triangle. And why are we looking for it? Well, let's take a look at this chart here. When we see price diverging into a triangle format and its development, we know at some point price must break out of this triangle. So as this triangle and price gets pushed farther and farther into this apex, we know that sooner or later it's going to break out. There's all kinds of rules. There's all kinds of interpretations that when you have an ascending triangle or symmetrical triangle and price moves in the apex, it should be a continuation pattern. You can do this and do that. Forget it. All we need to look for is the breakout, because we have no idea what price is doing until it breaks out. So simplifying your trading with price action and looking at it without overcomplicating the interpretation makes things easy, because all you're looking for ultimately is some type of clue about what price should be doing next, so that you can find a high probability trading scenario. Now, somebody once told me, let me just clean up the screen a little bit. Hold on a second. Someone once told me that most traders spend most of their time sitting on what we call the sidelines. It means you're looking, watching your charts, looking at your technical indicator, doing your strategy. Doing all that doesn't bring you any profit. Now, when you finally make a trade, what are you doing? You're inviting risk, because when you're sitting on the sidelines, you're perfectly safe. When you step into the great game, the first thing you have to do is you're taking on risk. You don't make a penny profit until you've closed your trade. So the most important thing of the whole thing comes down to booking profit, and that profit only comes when you close that trade out. Now, even though we're looking at simplified pieces of information by looking at price, we're also looking for, sometimes you want to look for maybe a doji, depending on your strategy and how you interpret it, you might be looking for it and combining it with some basic candlesticks, okay, like a bearish engulfing and a bullish engulfing. But you don't want to look for complicated, 3 white soldiers, 3 green this, 3 2 that. You don't want to look. You want to look for just something that are keys that you can see in the candlesticks. Okay, reversal, reversal. We see it in the candlesticks. Doji forming right on a support line, rejection from a resistance line. Okay. Now, all of this, we're making decisions. Okay, but we haven't made a trade yet. But we have to decide when we're going to do something and take an action. We have to get off the sidelines. Now, for instance, this is pure just conjecture, because I haven't done any analysis. In fact, today I've been very busy with other stuff, and I haven't even looked at the markets today. But now that we see that the euro has been climbing up steadily, and probably going to recover back into this range, and we've broken above this major resistance level, we're probably going to make it back up to this point, the new 108.91 that we just set on the charts. Now, there's no rule, there's no law that it's not going to break right through it and go up. There's no rule and law that it's not going to hit it and go down. There's nothing that we can bet on. But we know that this has become a key structural level. So we might want to say, okay, if price moves up to this level and bounces off on it, we would open a sell trade. Where we would open a sell trade is several points below the bounce off of this level. But someone did ask me a question a little while ago that I went off on a tangent. What we see below here is our volume. Volume is not an indicator, an oscillator, it's volume. Volume tells you what the markets are doing, what the people in the markets are doing. We need volume to support our trading decision. So in other words, if price came up here and hit off there and price started to fall and we saw an increase in volume, that means traders are making that trade, because we're not looking to find the top or the bottom. We want to know that we've got a bounce off of here, and we might just have a trade to this level, or we might have a trade to this level. But I would be willing to, if we got a bounce off of that level, I might have set up a trade to enter at this price and a target price here. I would have put my stop loss at my resistance level on my profit here and calculated my profit and loss ratio from that. But I would have needed volume to increase to tell me that those traders in the market are also seeing that price is about to ease back down. And so if volume either goes the other way or doesn't move at all, okay, then I shouldn't be initiating a trade. Now, volume's a strange thing. Volume, when you're trading a stock, not in a CFD format, but in a real, from the stockbroker, okay, and you're buying a stock that's traded on an internet, exchange, the New York Stock Exchange, the London Stock, every stock we know the volume for. If you're trading a commodity that's traded on the metals exchange or the commodity exchange, we know the exact volume, because every trade goes through every stock trade. If you're trading a stock that's traded on the New York Stock Exchange, every transaction goes through that exchange. So we're getting reports of true actual volume. If you're trading a contract for gold, all the gold goes through the London Metals Exchange, or it goes through the commodities into the US. We know that actual volume. When you're trading CFDs, or you're trading cryptocurrencies, or you're trading Forex, they don't go through any centralized exchange. And it's important to know, though, whether the trading volume is going up or down. So over the years, a methodology has come about, not by Alvexo, not by this stock provider, but by the markets on a whole. And it's mostly through the major liquidity providers, that the brokers place their trades through liquidity providers. These liquidity providers are very, very large, deep liquidity pools with huge amounts of money. So it's assumed that since different brokers use different liquidity providers, and many brokers use many liquidity providers, that a section of that liquidity can be generated to show you the potential in the real market or what an asset's doing. So in other words, if the volume for the euro has significantly jumped with several of the major liquidity providers, we're going to see a big climb here. It doesn't relate back exactly to the actual volume like on the New York Stock Exchange. It's a calculated number based on all the trades going through the liquidity providers. Now, we now have liquidity, we have volume, we have our support and resistance, we have our chart patterns. Now, let me just clean this up a little bit here a second. Okay, somebody did ask, is it advised to open a selling trade on the support line, sir, or wait for the rejection of the candlesticks? Neither one. Support and resistance, as I said, are zones. Okay. This is the steps in that ladder. Okay. Now, if price was climbing up that ladder and this was the next step, okay, I can't be sure that the guy going to paint my roof is going to take that next step up, or maybe he forgot something, is going to step back down. Okay. So I need to see what happens when he steps up to this step. I need to know whether he's going to step up to the next step, or maybe he's reached a window that he wants to paint the window ledge and he doesn't need to go up anymore. Okay. You don't make trades exactly on the support and resistance. You wait for some reason for it to come back down. Okay. And you need to combine it in other things. You have to decide on your own independently what pieces of information are valuable to you. Okay. Because, and how you're going to use them. Because the rejection based on a candlestick means you could wait forever for this combination to happen. You have to be able to look at this price, and as it moves up to this level, gets above, okay, what is it trying to tell you? Okay. You don't want to apply rules. You want to apply understanding. I'll try to give you a real life explanation having nothing to do with trading. You've lived in your house for many years. You also have had the same job for many years at the same office building, the same place. So you get up every morning at 7 o'clock. You go downstairs, pet the dog, push the coffee pot on, go upstairs, take the shower, come down, grab the coffee, go in the car, hit the garage door open. The car comes out of the driveway, and you're out on your street. You've kind of moved blindly. Now, you start going to the office. As you get 3 blocks down, you notice the school bus has stopped there. Well, you know, if you cut over on 3rd and go right on 4th, you can get in front of that school bus because you don't want to be stopped behind that school bus because you'll never get anywhere. Now, you didn't think about this consciously. It's from years of practice that you do this. Then you see when you get down 4th, you see the lights are clear, and you know if you hit all those lights right, you're going to make it all the way to the entrance of the highway without having to stop. And so you speed up a little to be on connection with those lights so you can make that straight run down. As you get on the highway, you know you're going to merge into that left lane of the entrance lane because you know you want to get over to the far right lane, the far left lane as fast as you can because you know what the morning traffic's going to be. You haven't consciously made any of these. You didn't stop. You got the radio going. You're thinking about your meeting. You know, God knows what else is going on while you. But you've done this automatically because you understood from experiencing this before. So I haven't looked at any rejection. I don't have a set of rules. I have a general feel and a general understanding for how that asset's going to be trading. Because now what happens is you finally, the kids are off to university, you sell your house, you move into a condo just a couple blocks away. Well, you know that old story, you've seen it in the movies. You get up in the morning, you pet the dog, but the dog's not there, but you still reach down because that's where you expect the dog. You go in the kitchen, you go push the button for the coffee pot, but you didn't realize because you were half asleep, you push the button, turn on the oven because it's not the same place. Okay. Now you forgot where your keys are. You forget where your car's in the basement of the building, and you pull out of the building and you're completely lost. Now getting to work is difficult. You have to pay attention to what you're doing because it's now a new drive. You're not by the school anymore. You're on the other side of the school. So this is what price action is about, is understanding and interpreting how what price is trying to tell you in its route to where it's going. Now, if and when you can do this by combining these little pieces of information to make it yours, because you couldn't explain to the guy who lives 3 houses down to you how to get, you'd give him one direction, but you couldn't give him all that information out of your head that about the school bus and making the lights all the way in. Because what we want to do is we want you to be able to get off those sidelines and actually make a trade sensibly. What becomes crucially important is not mentoring the trade as much as where you'd put your stop loss and how you'd get out of this trade if it was moving against you. Understanding the volatility of the markets, okay, and whether you should afford to make this trade, whether the potential target price outweighs the potential risk, possible risk and loss, and where to set your stop loss, and then where you can exit that market and take your profit. So you've done that final step and you've taken profit. So those are what becomes critically important, as opposed to overcomplicating. Am I going to trade in what price I'm going to enter the market? Because if I would take a look at, say, the euro right now, okay, if it broke through here, I might feel comfortable buying. If it fell off that price, I might probably feel comfortable selling because I'm either in a new trend, and what I'm seeing is a new trend develop here, and I've got my first push, my ease, and I'm going into retracement and a push and an ease, and I'm going into a new nice upturn trend. Okay. Or I'm just kind of starting to move sideways, but I'm bouncing off of a support and resistance line where I could get some nice little trades in also. So until I see more, until I visually see it, but remember, you can only trade going this direction. Okay. So you have to be able to understand what price is telling you at the wall. So let's get back to my PowerPoint because we're down to the last few minutes here. Let me get it back up on the screen. So the key to any successful price action trading strategy is the removal of periphery noise such as fundamental data and looking at price patterns, trends, and other forms of technical analysis. When combined with good old-fashioned experience and a feel for the markets, this can create a very high potential investment strategy. Don't forget, even if you've opened a position based on any of the following price action trading strategies, you can also use the technical data to set your stop loss limits. One of the key aspects of price action trading is using support and resistance levels. It is the fact that once the support level is reached, it can then turn into resistance and vice versa, all that we've just talked about. So just remember, support and resistance are the steps on the ladder, and going up, there the steps going up, coming down, there the steps going down. Now, there's many different ways you can read price. You can use pin bars and inside bars and outside bars. You can use rejection patterns and candles. You can use bullish and bearish engulfing. You can do a doji forming directly on the resistance or support level. Okay. You have to decide which patterns. Like I said, I love triangles. Okay. I love trading from triangles. But if you want to use inside bars and outside bars and the formation of baby bars and mama bars, that's perfectly fine. You have your support and resistance, you have your volume. You need a little bit more information to make the trade. So inside bars and mother bars are a fine way to do it. And then forming directly on support and resistance levels can give you a clue about what the market is going to do. But it's only when you take the time to understand how bar patterns or chart patterns or candlestick patterns emerge that, and what they indicate, that you can position your trades. But don't forget to keep one eye on the stop loss limit. As you gather information from the above information, price action trading is based around trends and momentum. The idea is simple. Once a trend changes, then the momentum often grows. It is only when a stronger opposing trend emerges that the direction changes again. In between these relatively strong trends, there will be periods of consolidation, sideways trading, and price will often bounce off of support and resistance lines. In many ways, support and resistance levels are self-fulfilling prophecies. Many traders now use technical analysis and take them into consideration. However, price action traders often offer the best of both worlds of using technical analysis and human input from the trader. So don't act with a trade until the market itself confirms your opinion. And this is done by looking at volume. Being a little bit late in a trade is insurance that your opinion is correct. In other words, don't be an impatient trader. Now, using price action trading and this combination will give you a relatively low number of trades, but they will be high probability trades. So unfortunately, traders using price action trading are often caught out by significant shifts in the market. This often means that not that you've lost your trades, it means you're losing other opportunities. You shouldn't be only using a single scenario to interpret the market. Many of the strategies we mentioned above are overcautious by some people. When waiting for a definitive change in a trend, there will be times when intraday prices could spike above resistance or below support, then recover. These could be false flags and could potentially expensive in the long run. And that's why you wait for a price to bounce off of something or above something. You wait for volume to confirm. You want to minimize your, or you want to maximize your high potential trades, and you want to minimize the false trades. So basically, let the markets talk and listen to what they are saying. So thank you very much for joining us tonight. I hope I gave you some stuff to think about, because that's all I can do is help you think and try to interpret those markets. Think about it being that route to the office. And this is one of the reasons we successful traders trade very few assets, because they want to understand each asset to its fullest. They want to have that roadmap to work. They want to have the feel for that asset. They want to be like the palm of your hand where you can read all those lines. And when you stick to just a few assets and a few trading styles, you have a better understanding of the markets. So think about having less trades and more successful trades. So thank you very much for joining us. And again, you can see a recorded version of this class by using the same link used to come to the live class. So, but give it 24 hours. Thank you very much and have a great trading night. Bye now.